The stock market can feel like it makes absolutely no sense sometimes. What if I told you that a company, one that was actively losing millions of dollars, could be seen as 80 times more valuable than a company making billions? It sounds nuts, right? But it's a completely true story, and once you understand how it happened, it reveals a fundamental truth about the wild difference between a stock's price and what a business is actually worth.
So let's just dive right in. How on earth can a tiny, money-losing company be valued at 80 times more than a massive, profitable one? Now, this isn't some classroom thought experiment. This really happened, right at the peak of the dot-com bubble. And trust me, understanding the why behind this whole situation might just change the way you look at the market forever.
So picture this. In one corner, we have what you might call a boring business. You know the type. Real products, actual profits, and it's been around for ages. And in the other corner, we've got the glamour stock. It's all about new tech, incredible hype, and, well, zero profits. The price tags the market slapped on these two are gonna blow your mind. All right, let's set the scene. We're going back in time to December 1999. The dot-com bubble is at its absolute peak. It was a time of just pure speculative fever, where the promise of the internet made traditional business sense seem, well, old-fashioned. And it's right here that we meet our two contenders. First up, we've got the Brown Shoe Company. This company was a rock, a true pillar of the American economy. They'd been selling a simple, tangible product, shoes, for over 100 years. This was the absolute definition of a stable, established business.
And their numbers? They were solid. Get this, in just 9 months, Brown Shoe pulled in sales of over $1.2 billion. And the crucial part? They had profits of $32 million. No matter how you slice it, this was a healthy, functioning, money-making company.
And our second contender? Red Hat. This company was the poster child for the dot-com glamour stock. They were in the super exciting world of open-source software, a major player in the whole internet revolution. Everybody was buzzing about them, saying they were going to change the world.
Okay, now let's look at Red Hat's numbers. In that exact same 9-month period, their sales were just $13 million. And profits? They didn't have any. In fact, they were losing $9 million. A pretty stark contrast to the billion-dollar profitable shoe company, right?
So on one hand, a profitable billion-dollar shoe company. On the other, a tiny, money-losing software company. You'd think it would be a no-brainer which one was worth more. But this, my friends, is where the story takes a truly wild turn. What price tags did the market actually put on them? The market decided that Red Hat was worth, wait for it, a mind-boggling $21.3 billion. That's billion with a B. For a company that was actively losing money, that was over 1,000 times its annual sales. Just insane.
And what about our stable, profitable Brown Shoe Company? Its market value was a measly $261 million, not even $250 million. Just let that sink in for a second.
So, there you have it. The public, in its infinite wisdom, decided that a tiny, unprofitable business was worth 80 times more than a profitable billion-dollar company. This is a perfect example of what the legendary investor Benjamin Graham called complete heedlessness toward a business's real value. The big question is, why? To make any sense of this madness, we have to turn to the father of value investing himself, Benjamin Graham. He argued that the market is basically made up of two kinds of people with two totally different mindsets, speculators and investors. And this simple framework is the key to unlocking our whole story.
Speculators, Graham said, don't really care about a company's actual value. All they're doing is betting that the price will go up simply because someone else, a greater fool, as they say, will be willing to pay even more later on. This greater fool theory was the engine that was pumping Red Hat's valuation into the stratosphere. An investment, though, is a completely different ballgame. It starts with a deep, thorough analysis of the business itself. And the goals are super simple. Number 1, protect your initial capital. Don't lose your money. And number 2, earn a decent return. It's all about what the business is actually worth, not what the crowd thinks the price will be tomorrow. And Graham had this brilliant way of putting it. He told people to buy stocks like they buy their groceries, focusing on price and value, not like they buy perfume, where you're just swayed by emotion, glamour, and hype. Red Hat, that was some seriously expensive perfume. Brown Shoe, that was like finding your favorite cereal on a massive discount.
Okay, so how can the market get things so incredibly wrong?
To explain the market's irrational behavior, Graham came up with this really powerful metaphor. He wanted us to imagine the entire stock market as this one single, super emotional business partner he called Mr. Market.
So, Mr. Market is basically your crazy business partner. Some days he's totally euphoric and he'll offer to buy your shares at absurdly high prices. That was him during the Red Hat frenzy. But on other days, he's panicked and depressed and he'll offer to sell you his shares for next to nothing. That was him with Brown Shoe. The trick for an intelligent investor is learning to just ignore his manic episodes and take advantage of his moments of despair.
So, if Mr. Market is constantly swinging between crazy highs and devastating lows, how do you protect yourself? How do you make sure you don't get swept up in the madness and end up overpaying for a stock? Well, Graham gave us one crucial principle that acts as the ultimate safety net.
Graham's solution is the margin of safety. And honestly, this might be the single most important concept in all of value investing. It simply means buying a business for way less than what it's really worth. Buying Brown Shoe at that depressed price gave you a huge margin of safety. Buying Red Hat at its absolute peak, it gave you no safety net at all.
So let's wrap up with the key lessons from Graham's playbook. First, always remember that a stock's price is not the same thing as a business's value. Second, learn to treat the market's mood swings as your servant, not your master. And third, and this is the big one, always demand a margin of safety when you invest. It's your ultimate protection against the market's madness.
You know, the story of Red Hat and Brown Shoe happened over 2 decades ago, but this same dynamic plays out over and over and over again. The names of the companies change, the industries change, but that fundamental battle between real value and pure hype, that's eternal. Which brings us to a final, really important question. What is today's Red Hat?